Welcome everyone to our latest SPE France technical webinar event titled Market Turmoil, the Corporate and Upstream Response. I'm Carla Castillo. I'm a reservoir engineering professor at FP School, as well as student chapter liaison of SPE France. And today are with me my fellow board members, Pierre-Edouard and Rodrigo Rueda Terrazas, as well as our chair in the SPE France, Fabiola Maisonnier, that will be with us during all the events. We are expected to be together for 60 minutes. We encourage you to ask questions during the entire session, and we will use it to fuel our discussion. Most of you will be joining through LinkedIn, but if you're experiencing any technical difficulties, don't hesitate to use our alternative YouTube link provided on the LinkedIn page, okay? Just so you know, the event will be recorded and later available on demand on our various different platforms. Okay, so just before we start, I would like to show a presentation, very brief presentation on SPE France, so you can join us if you're still you're not yet a member. Okay, so the board of directors of SPE France, you can see us all together here. Our section chair, it's Zahraa Alkalby from Total Energies. Here you have all our pictures. And well, we have been very busy this year with different events. We are located in different cities of France. And so before I present the event, I would like to give you 4 reasons for benefits that members of SPE enjoy or take advantage of. And the first one is that we are database, let's say, as a resource center of technical knowledge. So you have the different online platforms, JPT, the former magazine that now it's only online, different sources dedicated to different domains, technical sections. You will have the opportunity to meet and share information, knowledge with peers, with collaborators, volunteers around the world, not only France. Therefore, it's a huge networking opportunity. As a third point, I will mention the access to training and certifications online, in some occasions on site, depending if you attend any of our conference. So that help with the professional development. And of course, it's the opportunity is a platform to recognize the best people in the energy industry. So our activities, in a nutshell, so the monthly conferences, such as this one, online and on-site, networking events, partnerships and collaborations with different companies and other associations, as well as the support we provide for students, such as their involvement in the Petrobol, mentorships, one-to-one, or groups for sharing technical knowledge experience, and even for field trips that the students organize. So our main event this year was the anniversary event, the 40th anniversary event for the section that was held last March in the Arts and Métiers Museum here in France. Our sponsors, different companies related to the industry world that supported an event that lasted between 4 and 5 hours. The BTB Beyond the Borders 2025 also held simultaneously with the anniversary event. We have people coming from different continents, not only from Europe, and it was a first since 2018. That was the last time we held the BTB. And last but not least, we co-host with the IFP School SPE student chapter, the Europe regional qualifier of the Petrobol. This event took place in April, just 3 weeks after the anniversary, and we had the opportunity to gather 15 universities from across Europe, 10 countries in from coming to France. So that's all for me. Please remember to join to renew your membership to SPE France. Just a few announcements. The next General Assembly will take place on July the 8th. If you're a member of the society, you will for sure you receive the invitation. You can send someone else with your power to vote in case you cannot attend. You can also join at any moment in the year the society if you are, as I said before, you are not already a member. And well, don't hesitate to reach out through our website. So contact at spefrance.org if you have any questions from us. Okay, so thank you for your attention about the SPE France moment. Now it's my pleasure to hand over this scene to Rodrigo. Please go ahead.
Thank you, Carla, and thanks everyone from the SP team to helping in the event, and as of course to Wood Mac. We're very happy to bring Wood Mac or Wood Mackenzie, as they'll further explain the difference in a few moments. And as you know, this is yet another of our online webinars that we host. We also do hybrid events, and we have plenty of them planned for the next semester of this year. On top of some events that we'll do during the summer, we'll detail them more at the end of the event. So we need to take some time from our speakers, and we wanted to bring some. We hear, of course, our members and what are their desires and interests to our general member survey that we do every year, and one of them was to grasp a little bit more on the geopolitical scene, on the more current events, and bring this closer to our audience. So this was the aim of the event today, and we're lucky to have Fraser and Evan with us. And so we know for the delay, I introduce it. We have Fraser Mckay, head of upstream analysis, and Evan Jeudi, forgive my bad pronunciation, corporate research director. And I'll let themselves further introduce themselves as well as Wood Mac and carry on. Thank you so much.
Thank you, Rodrigo, and thank you, Carla. I hope you can all hear me okay. Yeah, so my name is Fraser Mckay. I'm head of upstream analysis at Wood Mackenzie. Wood Mackenzie is an independent research and consulting practice. We've been going for about 50 years. We're not McKinsey and we're not Wood Group. We are Wood Mackenzie, and we provide independent thought leadership and data and analysis to the energy and natural resources sectors. So we're the only practice that covers all sectors and all regions. And one crucial thing that we do a bit differently is almost everything you'll see from us today is bottom up. We do a handful of things top down where necessary, and we do comparisons with top down data. And by that, I mean, a global demand number. Our global demand number is built up by looking supply node, demand node, sector, country, region, and we build it up from the bottom rather than making an assumption at the top level or taking anyone else's numbers. So that's what we do. On the upstream side, I've been doing this for a long time. I'm not a petroleum engineer, so don't ask me any petroleum engineering questions, but I did work for Schlumberger and I've seen a lot of logs. So yeah, I know what you're doing. I just couldn't do it myself. So you're the smart ones here, and we're looking forward to all of your questions. I guess, Nivan, if you want to give a quick introduction to what you do at Wood Mac.
Yeah, no, thanks, Fraser, and good afternoon, everyone. So, Nivan Borogerdi, I work within our corporate team at Wood Mac. I've been with the business now for over 10 years. Actually spent the majority of that working alongside Fraser within our upstream division, but have recently moved over to corporate to lead our national oil company coverage. So great to be on the call today and looking forward to a good discussion.
Perfect. And if we could bring the slides up, we'll get going with the content today. what we're planning to take you through, thank you very much. What we're planning to take you through today is the title of it about the response to volatility was certainly born of initially of the trade war or tariff war rather that was developing in April. Since then we've had real wars as well added to the mix and then a ceasefire. So a lot has happened in the time since we first started talking about doing this presentation until today. But a lot of the content or all of the content is still relevant. So my role here is in the next 10 minutes or so to take you through some global high-level content about upstream investment, and then Nivan's going to take you through how companies are responding to that and how they are positioned to cope with some of those uncertainties. I will start, for those of you that are relatively new to the industry, by saying that uncertainty has always existed, sometimes large, sometimes little, usually ever changing. So this is not a new phenomenon, but there are some new elements to that. There's new geopolitical elements that didn't exist before or have changed. But specifically, there's also demand elements that have changed. And at the end of 2024, certainly in the second half of 2024, it was clear that the energy transition was not going as quickly as some people had predicted. We have maintained our base case throughout the sort of 2021 period of strong focus on a net zero trajectory. And it's not that we didn't want that to happen, it's just that we saw it as being very unlikely to happen given the investment constraints in the ability to build out a low carbon system quickly enough. So we have always maintained there would be a need for oil and gas for many, many decades to come. And everyone will have a different view on the trajectory on how to get there. But I'm going to share the way that we look at the world. And in the second half of 2024, things were looking like a greater acknowledgement from countries and from companies that the transition was not going to be as rapid and that considerable investment was still required in upstream oil and gas, which is, I guess, why we're all here. So I'm going to take you through that. But as we came into April 2025, obviously with some global economic headwinds, including the US's actions on tariffs, things didn't look so great from an oil demand perspective, and something that we'd been talking about for a long time, which was an excess of supply from non-OPEC sources entering the market in 25 and 26 was starting to cause a problem. So suddenly we've gone from an environment where companies are more bold about their long-term strategies into one where they're having to worry about low prices. So this first chart shows you something that we call it's an operating cash flow break-even and a cash flow break-even. But basically the way to think about that is the Brent price required to create positive cash flow to make money in an individual year from an oil and gas asset. So if it's a producing asset, what Brent price would you need? Each one of these dots is a global asset somewhere in the world, and the $50 aspiration that the US government seemed to have earlier in the year. And what I can tell you is that the dark line, this is just operating, so that does not include capital investments, that's just covering operations and that kind of thing, the operating costs of getting the oil and gas out the ground. Almost no oil is uneconomic or not making any cash flow down to probably considerably beneath, more like $40 a barrel before any sort of production is threatened by price. But when you look at it on a capital basis, when you look at it on a full investment basis, 10% of the world's oil supply does not produce positive cash flow at $50 a barrel. And that's really important because it gives you a sort of scale of how quickly companies would react to lower oil prices. So we got down beneath $60 a barrel in that time frame, and before the hostilities in the Middle East ramped up. So oil prices, the fundamentals were pointing to an oil price that was between $50 and $60 per barrel, and we were getting there. And that tells you just how quickly companies might respond to a downturn in oil price. So we're going to cover a little bit about that in this presentation and what companies might do. But we're also going to talk about the long term. And the reason I want to talk about the long term is because, as I mentioned at the start, we have at Wood Mackenzie a delayed energy transition scenario. And that delayed energy transition scenario means a peak of oil demand and gas demand that is approximately well, more than 5 years for gas, 5 years for oil later than our peak in our base case. Our base case is that light line, and the delayed energy transition is the dark line. And this is the one that's had a lot of attention from investors, from companies, from governments. More recently, we do have 2 other scenarios, one at 2 degrees and one at 1.5 degrees, which is what governments have committed to, and a net zero scenario respectively. I'm not showing them here purely because I want to talk to you about the implications of a delayed energy transition scenario, and that at the moment that does appear like the direction of travel. It doesn't mean that the delayed energy transition is now our base case, but it does mean that the probability of that happening is now greater. If you add 6% more oil and 3% more gas, you get 5% more supply required. So we ran this through our global models. One thing before I leave this slide to point out is that the shaded area is what would happen if there was no investment in oil and gas. And that decline is far greater than any possible demand scenario, and certainly very far, as you can see, from any probable demand scenario. So that tells us already we need a considerable amount of investment in oil and gas. Where would that oil and gas come from? The additional supply required to meet the delayed energy transition? Well, it's no surprise that it would come from a lot of the areas that we already get oil and gas from. Yes, those might be slightly more complicated prospects and resources and projects, but it's mainly Middle East. It's mainly conventional, though obviously unconventionals in North America do have an impact on this. And in areas like deep water, the reason we might look at that and say, well, why isn't more than 10% of that increment coming from deep water? It's an exciting area. It has low scope 1 and scope 2 emissions. It has a good economics. There's lots of exploration frontiers in deep water, etc. And the main reason is actually supply chain constraints. And that's what I'm going to talk about next is, well, okay, what would actually happen if we had to bring this supply in our base case plus this increment to market? And in the supply chain world, and I know there's quite a number of people from the supply chain world on the call, they'll be very familiar with this story. This is actually one that is a reported number. It's not a Wood Mackenzie number. This is the top 4 supply chains reinvestment in their businesses since the 2010s. Now, the 2010s were what we call peak inefficiency. So things were definitely being overspent back then, but you went from adding capacity, spending $12+ billion per year, to spending more like $3 or $4 billion a year, of which up to 1/3 is not adding capacity in upstream supply chain. It's adding new business units, digitalization, AI efforts, etc., etc. And that means a very different supply chain when we engage with it, asking it to do more to create that 5% more supply. So we ran this through our global supply chain model. We ran those supply numbers through our global oil price model, and we came up with a view on what cost inflation would look like in that scenario. And the answer is very non-linear. So you ask for 5% more supply, and you don't just ask for 5% more spend. So when we looked at the declines from existing assets and what would need to be overcome, and you're also making some of those more complex projects happen sooner in time than you would do in the base case. And we discovered that you'd need to be doing basically 10% more activity. So you've got a base case decline rate. You're adding to that activity to get you to our base case demand number, and then you're having to add on that 5%. That means actually in aggregate, you're doing 10% more things to 2050. Also to 2050, all of those individual countries and all of those individual resource themes that I told you about that we analyzed, it came to very close to 20% cost inflation. That's a weighted average number. Some sectors would be higher, some sectors would be lower, some sectors it happens later rather than earlier. But on average, on a weighted average basis, it's 20%. The combination of 10% more doing stuff and 20% weighted average cost inflation also just happened to be 30% more spending. And it's also that combination of more expensive projects, higher break-even projects in the future too. So that's what gives you that non-linear response there. And I can tell you that if you went to any of the companies that Nivan's about to talk about and asked them to spend 30% more than they're doing today, you're not going to get a positive response. And if you went to any of the supply chain companies that are on the phone today or in the industry and said, we need you to expand capacity for the advent of this, they're also not going to be doing that without the economic incentive in front of them. So something needs to change to make this happen. And unfortunately, we no longer have a pathway, which there was still a very, very, very faint potential of a pathway between going smoothly from 2024 to this delayed energy transition scenario. The uncertainty introduced by the geopolitics, by the current oversupply situation, and all of the things that are making oil prices closer to $50 today than they are to $70, is very likely to delay this and make companies think even harder about allocating capacity increases and allocating spend to that. I'm going to hand over to Nivan right now, but just before I do that, I can't see any questions yet, so none of you are passing the test on asking us lots of questions. So if you could put some questions in for me and for Nivan, we can also talk about the impact that this would have on the market as part of the Q&A, but I hope that was helpful. Over to you, Nivan.
Thanks, Fraser. So now we're going to look at some of the issues that Fraser raised through a corporate lens, and specifically how our company is going to sustain cash flow into the next decade and beyond against the backdrop of all this uncertainty. Now, a few years ago, there was a sense that companies could sustain cash by diversifying into other areas like renewables, CCS, hydrogen, with a strategy that's maybe more compatible with a net zero world. But as Fraser pointed out, a delayed transition, or at the very least, Wood Mackenzie's base case view of the world, seems more likely to play out. And as a result, we're seeing more and more companies now lean back in towards upstream. And so we wanted to start this section by looking at production by resource theme for 4 key peer groups here. So we've got the Middle East NOCs, we've got the US majors, the Euro majors, and then the Asian NOCs. And if we kick off with the national oil companies in the Middle East, what you can see here are a peer group that's a huge source of production, investment within the industry, and this is a share of production and capex that's going to grow in the years to come. Now, domestic expansion has been at the heart of the growth story for these companies. We've seen lots of big mega projects in oil, gas, and LNG. We're now also seeing these companies step out beyond their domestic asset base. So looking to internationalize and diversify their business beyond domestic oil and gas. And if we think about 3 of the companies in here, ADNOC, Saudi Aramco, and Qatar Energy, all of these companies are producing more in 2040 than they are today within our base case. Now, there are some similarities with the US majors as we move along. Exxon and Chevron have certainly stolen a march on their European peers through big acquisitions, increasing exposure to the lower 48. And you can really see that here in the big wedge of unconventionals that you see in the chart at the top there. Exxon's also growing in deep water. We see that through its position in Guyana, testament to some of that exploration success that it's realized over the last 5 to 10 years. I should point out this chart doesn't include Shell's potential acquisition of Hess. That is something that we expect a decision on in the coming weeks. In the event that it does not go ahead, it will certainly be interesting to see what Chevron does next. For the Euro majors, certainly Total and Eni will stand out for near-term growth, particularly in deep water, where we've seen exploration success in places like Namibia and the Côte d'Ivoire. But overall, we see a much more significant decline for this peer group. And Shell is the top IOC that we see in this slide here in terms of LNG. But alongside BP, it's been probably more focused on winding down its upstream business than growing it in recent years. And what that's done is it's left the companies short of future growth options. And it's now why we're seeing lots of chatter around potential mergers, acquisitions, even a tie-up of Shell BP. But that longevity challenge is even more acute for the Asian NOCs that we see towards the right-hand side of this slide. Now, over the past few years, we've seen lots of spend being directed domestically for these companies. They have been growing production, but we do see barrels and molecules becoming increasingly costly to develop in parts of Asia and China in the coming years. And we see real challenges in maintaining those current levels of production. So the key takeaway here is most companies within our corporate universe really need to address these next decade challenges. Now, if we move on to the next slide, it's fair to say the industry certainly has form for adding new volumes, either through M&A, exploration, increased recovery, but we think the challenge this time round is even greater than it has been in the past. And the chart on the left here tries to kind of summarize that. So what we're showing is for the top sort of 30 companies that we cover within our corporate service, we've looked at what we felt these companies were going to produce 10 years ago versus our current outlook today in that top line. And you can see that the companies kind of underperformed production in the short term. That was due to project delays, cost overruns, the sale of certain assets. But for the most part, the industry does add volumes in the longer term. And you can see that now that peer group is set to produce 17 million barrels of oil equivalent more per day in 2030 than we thought that they would. So as I said before, a lot of that coming from M&A, but also some of it from exploration and increased recovery. But if we now flip to the right-hand side chart, if we take our current view of production out to 2040, we see a much steeper decline, and we see more barrels having to be added to basically for these companies to maintain their current share of production. And that's in both our base case, which is our energy transition outlook, but also that delayed energy transition scenario that Fraser pointed out earlier. So these companies have got a huge challenge on their hands to add more barrels to maintain their current share of production. So how are they going to do that? Well, it's now intuitive to look at what filled that 17 million barrel per day target last time. And you can see from the slide that we're showing here, we have that split by peer group on the left-hand side, then resource theme, and then hydrocarbon type. And I think a key takeaway here is if we think about it firstly through a company lens, the Asian NOCs were able to get more out of their domestic portfolios. So they were able to apply more capital. They were fundamentally able to produce more from those assets than what we thought that they would. Is that going to be possible next time round, particularly with more technical challenges, some of these barrels and molecules becoming increasingly costly to develop? We don't think so. The emerging majors were able to add more barrels. That's largely a big consolidation story, and largely it's a consolidation story in the US. And we see that in the middle chart here, where most of the volumes that these companies have been able to add came from unconventional oil, largely in the USA. A further point to add is if we think about the chart on the right-hand side, we see the difference between gas and liquids. I think what we're really highlighting here is oil fields, particularly big oil fields, tend to get bigger. And as a result, they tend to produce more as we move through time. So what I take away from this is while the industry has been able to add volumes in the past, in the event of not having another tight oil, of not having multiple Permian basins to call on, the industry is going to have a big challenge to maintain its current share of production going forward. Luckily, it's in a pretty good shape to do that. So if we move on to the next slide, what we're showing here is effectively the capacity that these companies have to both survive in a volatile price environment, but also to undertake counter-cyclical M&A. The chart on the left here comes from our Corporate Resilience and Sustainability Index. So this is a new framework that we have added in recent years to try and quantify two things. When we think about resilience, how well equipped are companies to navigate a near-term price shock? If we think about sustainability, it's much more forward-thinking. How well equipped are the companies to navigate the transition, not just in the next few years, but then also the decades ahead? Now, what we're focused on here is the resilience piece, and we're specifically looking at the platform pillar within that. And that looks at two key things: balance sheet strength and also scale. And what you can take away from this chart here is that from a balance sheet perspective, most of the companies within our corporate universe look to be in pretty good shape. And you can really see it on the chart on the right-hand side. Here, we're looking at the company gearing ratio on the y-axis, and then we've also looked at shareholder returns on the x-axis. So this is effectively your dividends and buybacks as a percentage of cash flow this year. And a couple of key things here. Number one, most of the companies have got fortress balance sheets. They've got a gearing ratio of 10% or less, but the NOCs really stand out because they don't have the same shareholder constraints that are shared by a lot of the other IOCs. For most of these companies, their investors want growing, sustainable dividends, particularly in what they might see as a maturing sector. The NOCs don't have those same constraints, so arguably in a better position to buy assets, buy companies, undertake that counter-cyclical M&A. Because the competitors, as I mentioned before, a lot of those IOCs, they are super disciplined. There's lots of competition for capital, and the days when these companies are going to be outspending cash flow are gone. And what we're showing here are really the reinvestment rates for the companies within our coverage for this year, and you can see that they average around 65%. So roughly what we're seeing is the rest then either going to pay down debt or going back to shareholders through dividends and buybacks. Now, there are, of course, outliers, as there always will be. Within these data sets, there's companies towards the right-hand side that still continue to invest, that still have reinvestment rates above 100%. A lot of this can be specific to the countries that they're active in. It can often be NOCs that have a government mandate to really try and grow domestic production at expense of shareholder returns. But for the most part, I think it gives you a real sense of the challenges that companies have right now. They have declining portfolios, they need to grow production, but they have to also stay within financial frameworks, and they have to still give lots of money back to shareholders. And so lots of spend is coming under scrutiny. And if we move on to the next slide, it's part of the reason why we're seeing companies dial back a lot of that low carbon investment that they were promising only a couple of years ago. Now, the chart on the left here looks at capital allocation split between low carbon at the bottom. That's everything from CCS, decarbonisation, hydrogen, right through to renewables. And then we've got legacy oil and gas in the light colour here. So that's both upstream and downstream. And if you think a couple of years ago, the Euro majors were effectively telling the market that they were going to spend 30 to 40% of future capex on low carbon. You can see that's really been dialed back over the last couple of years, back to around 10 to 15%. And if we now look at spend in absolute terms, if we bring up that right-hand side chart now, you can see a huge reset for the likes of a BP, Equinor, a lot of that coming from slashing spend in areas like renewables. And if we now look at the biggest spenders in low carbon, it looks like for now Total is sticking the course with its dual growth strategy in both oil and gas and renewables. But the other big spenders are Middle Eastern NOCs and ExxonMobil. That's something that would have been unthinkable a couple of years ago. For the Middle Eastern NOCs, a lot of that is about advancing countrywide low carbon targets in areas like renewables and CCS. So maybe they're less likely to dial back in line with some of the majors that we see here. And of course, for Exxon, it's a massive CCUS story, particularly in the US through the acquisition of Denbury. So that is an overview of capital allocation. The final slide I wanted to leave us on was looking back towards the upstream. And this is where we use our corporate strategy and analytics service to really determine what's core and non-core to the companies that we cover. So each of the bubbles that you see here is a country position. And we've ranked that country position by whether it's core or non-core on the x-axis. So this is a proprietary Wood Mackenzie metric. Effectively, what it looks at is a country's share of overall investment, production, and value, and how that compares to the wider business. We've also got maturity on the x-axis, which is effectively your remaining resources over your initial resources. And if we think about potential opportunities for lots of the companies looking to lean back in towards upstream, looking to grow production, a lot of those could come from that top left-hand side quadrant. From companies that are big, that have got lots of growth opportunities, that might want to dispose of some of those peripheral or non-core assets. A couple of key takeaways: the US majors are a lot more concentrated than their European peers. That's clear. I also want to just leave you with the NOCs towards the right-hand side here. You can see how concentrated they are towards their domestic business, but also gives you a sense of maybe why some of them are stepping out beyond that domestic asset base to really grow and diversify their business. So that is a quick whistle-stop tour through the corporate scene, but as Fraser said before, we're happy to take any questions on that.
Thanks, Nivan. Rodrigo.
Thanks, Nivan and Fraser. We have a question here from our YouTube channel. It says, your slide showing regional trends was showing sharp decline in output and investments volumes for the Asia region. Sorry, how do you explain this?
Yeah, I mean, this is largely down to the maturity of those respective sectors. So if we think about, onshore China, for example, we're seeing recovery rates now reach a sort of limit based on current technology. Now, these companies have been deploying lots of capital to try and grow domestic production in recent years. CNPC has been the biggest upstream spender globally over the last decade. But we're seeing now challenges in maintaining that current level of output. And that is because of those increasing recovery rates, because they're having to drill deeper and deeper shales, they're having to look elsewhere for exploration. And effectively what it adds up to is much higher costs per barrel than what some of these companies even have within their international portfolio. So without that advancement in technology, or without a new exploration province in some of these countries, we see difficulties in maintaining that current share of production, and that's what results in some of those more severe decline rates versus maybe some other portfolios that we're showing.
I guess just a couple of things to point out on that is that the chart that Nivan showed is the commercial base case for the Asian NOCs, not the entire region, is the first thing. Though all of the arguments that he made are absolutely accurate, it doesn't include exploration. So those estimates are from assets that exist today that are economic, and there is plans in those companies' development portfolios to develop and pursue, which does include some unconventionals. There's still a lot of effort going on into tight gas and shale gas in China, for example, and a lot of those volumes are in China. So it will look different post exploration, post delineation, etc. But it's a significant challenge, and overall, in terms of oil and gas supply mix, we see a lower percentage of the global requirements being satisfied by supply from from Asia.
Excellent. So I have another question. So first of all, Fraser, you did a really good job. Incredible presentation, very clear, very insightful. So the question is, how is the current uncertainty affecting capital allocation decisions and project sanctions?
Thank you, Fabiola. Nivan, I guess I'll take a first stab at that. This year, certainly the projects that we're tracking, we track every global project, but we tend to look at the larger ones as an indicator for sort of industry confidence. And in any given year, the average historically has been between sort of 20 and 30, but we've had some real highs and we've had some real lows as well. Since the last downturn, since 2021, we've had an average of just over 20 projects per year that are bigger than 50 million barrels in size. This year, until a couple of months ago, we'd only had like 4 or 5. There have been a few more in the last few weeks, but we wouldn't anticipate that you're going to see another year of 20 projects, 20 major projects plus sanctioned. The reason for that isn't because the projects have gotten worse, and it's actually, I don't think, because the companies are looking at these projects and thinking that their economics are very different, because most of them wouldn't actually be producing much in this period of uncertainty the next couple of years anyway. But what it does tell you is, as Nivan discussed, is that companies are going to look at how they allocate capital over the next couple of years to keep their balance sheet strong, to keep debt as low as possible, and to continue, more importantly, providing distributions to shareholders, so dividends, and in some cases continuing to buy back shares. So that just means that they're going to try and reallocate that spend perhaps into 6 months later, maybe even a year later. And whilst they're doing that, and whilst activity is lower and contract awards are lower, maybe also they can negotiate a better price with suppliers as well. So it's a double-edged sword. And if they see that happening, then they're even more likely to delay other projects in the portfolio as well. So it becomes a bit of a compound effect. But we don't think we're in a downturn, and we don't think that it creates a pause in activity, but we do think it just makes companies think 3 times instead of just twice on sanctioning new projects.
And for those decisions as well on projects in terms of carbon and low carbon, the trend I could see on one of those your slide, do you think the trend is going to keep that like increasing, or do you think it's going to stay as it is or even lower?
Do you mean the share of low carbon investments and how that's going to evolve? Look, I think that we've seen a fundamental reset from certainly some of the biggest oil and gas companies to around that sort of 10 to 15% of overall spend. But of course, if we start to enter something approaching a more accelerated transition scenario, then these companies are going to have to start, stepping up investments in the low carbon space again. I mean, no company wants to tell the market they're going to be a smaller company, 5-10 years from now than what they are today. And so the whole idea around this was, to add sustainable cash flow, to diversify their business beyond what was felt to be a maturing sector. But a lot of the events that Fraser, highlighted before, have shown that, we think that transition is progressing slower than what we would like. And so I think for now, we are seeing a bit of a lean in back towards upstream, and companies now looking at upstream renewal again, which they probably haven't been, or certainly in this part of the world, over the last few years. But it's not to say that, renewables and CCS and hydrogen and these things don't advance. We will see advancements in all of these technologies to a certain degree. It's just that in the short to medium term, I think oil and gas companies look like they're going to play a smaller role in that advancement than what we thought they would a few years ago.
Thank you.
Can I ask a question and maybe a comment on that specific question, Neven? The slide on Asia, I don't know how dwarf it might be by information and data from China, but China definitely strikes me as one of those actors capable of investing massively in infrastructure towards renewable and other sources of energy when other actors cannot do that. Do you think that could explain the slope downwards?
Look, we still see growing supply gaps in China. Obviously, China has made massive advancements in renewables. It's looking to deploy more nuclear. Coal obviously still plays a massive role, but we still see, even in those scenarios, a significant role for oil and gas. And by our numbers, we do see a bit of a growing supply gap in the years to come. Now, that's not to say that they can't deploy even more capital to increase production from their domestic asset base. I think they will do so. And as Fraser mentioned, that outlook that we're showing, that's what we see as commercial today. Of course, we could see advancements in technology. We could see increases in exploration. We could see them willing to recover higher cost barrels and molecules. But as we see it today, we see rationale for the Chinese NOCs to start looking internationally again. Now, they haven't done much over the last 10 to 15 years. And a lot of those deals that they did do during that period maybe didn't work out quite as planned, as they didn't for any buyer during that period. But we do see opportunity for that group of companies, and there is that domestic situation which is driving that, but I also think it's the external market as well. There aren't as many buyers in upstream oil and gas as what there were 10, 15 years ago. There is a window of opportunity for buyers of scale that have strong balance sheets to really take advantage of the current situation.
I think what the other point that you made on, are we factoring a lower oil supply number in due to their ability to ramp up in low carbon? You could also ask yourself, was there an increased focus on low carbon because there's an expected downturn in oil supply, or in this case, oil and gas supply? So the answer is probably somewhere in between, to be honest. But as Neven's mentioned, and there's lots of dynamics around where China's energy imports come from and the geopolitics associated with that, which have all changed in the last 6 months again in terms of how it likes to balance sources of supply and security of supply. And none of the major suppliers of gas to China have proven themselves to be particularly reliable as it relates to either the US or Russia as a trade partner in the last 3 years. So of course they're going to try and increase whatever they can do domestically, and that includes coal, by the way, as well. Which, going back to Fabiola's point on emissions, is obviously a negative aspect.
Yeah, there's another question. Carla, would you like to take that one? Carla, you are muted.
Can you hear me now?
Yeah.
Okay. U.S. conventional production kept on increasing over the last 15 years, thanks to better efficiency in well construction and well delivery, thanks to rig technology, reservoir contact, and fracking optimizations. Your slide 12 shows a negative growth rate in the U.S. towards 2040. Why is that? If you can elaborate on that, please.
I'll let
Sure.
Fraser take most of this, I think, but I just want to qualify the numbers here, and just to say that, you know, what we're showing in slide 12 is obviously an outlook for the US majors. So it's not necessarily US production. There will be parts of the US majors portfolio elsewhere that will be declining at a much sharper rate than its US output. So that just to sort of qualify that. But I'm sure Fraser has an answer on the overall outlook for US production.
So yeah, I mentioned the 250 analysts that Wood Mac has around the world in 100 plus locations, and of that, some of them are in Houston. Many of them are in Houston, and I used to live in Houston, so I'm very close to the unconventional sector. And yeah, every time the unconventional sector is written off, it outperforms, and usually that's because it's written off due to low prices. And low prices are the mother of invention as it relates to unconventionals. So it took high prices in the first instance to unlock the technology associated, largely the technology associated with unconventionals. And then every time we get low prices, we get surprised by what the sector can do. We have, that's again a commercial forecast for well locations that exist today that make sense under our forecast prices. There's ways in which that number could be higher, and as Nivan said, that's also only 2 companies. But if you look across the broader sector, it's not that dissimilar. You do get a plateau, we think, for quite a long time, and then it does start to drop off. But can that be outperformed? Yes, it can. And are we already seeing some of the technologies that could do that? Yes, we are. And actually, ExxonMobil is definitely at the forefront of that. And there's a whole webinar in terms of how they're trying to do that and how they're including and incorporating huge data and analysis processes, AI, but also the integration with development and specifically on how you optimize development mid-cycle, like during the development phase, to optimize for value. It's a long story, but what that tells you is that yes, there's a strong argument to be made that tier 1 locations, i.e. the best subsurface, will be largely drilled out in the next 5 to 10 years. However, smaller wells from less productive reservoirs and less productive areas of existing plays are getting more economic. So that doesn't mean that you suddenly add another 1 million barrels a day from tight oil, but it does mean that you can turn that decline around and you can hold that plateau for longer while still generating good economics. So I think even if you're not personally focused on unconventionals, you need to keep a really strong focus on what's happening there. A, because it's your competition, and if it gets cheaper, then that's really important for you to understand how your project or your area is competitive relative to unconventionals. But B, there will be things that we can learn in the conventional space from what's happening in unconventionals. Not everything can be transferred because it's 2 very different operations and 2 very different everything is almost different about unconventionals, but the way, not what they are doing, but the way they are doing things, some of that will be transferable. And where it isn't, the conventional space needs to reinvent that itself. Otherwise, it will not keep up. So it's a really good question. Thanks for asking, whoever asked that question.
It was Hervé's question. Thanks, Hervé.
Thank you,
So
Hervé.
there's another question, Rodrigo, if you like the one is additionally from Diana.
Yeah, thanks, Fabiola. Yeah, we have a question from Diana Shigapova PhD, she mentions, in addition to her best question, conventionals will grow according to the forecast. How is it correlated with the $50 Brent level and the drill baby drill, let's say, approach?
Or as we called it, delay
Or
baby
sorry,
delay.
yes,
Yeah,
exactly.
and I guess what we were the comment we were making there was that, and it seems obvious probably to most people on this call, but you can't get drill baby drill and $50 a barrel, which was the two competing aspirations of the Trump administration. The two are incompatible. $65 is the knife edge point for do companies maintain activity, and that's really to hold things flat or grow moderately. Beneath that, they start to decline. Declines don't show up for 9 months or so, but if prices went to $50, you would start to see declines towards the end of the year and into 2026. If prices stay where they are, it's very likely we'll see a flat year on year, perhaps with a entry to exit fall in 2026. And if it goes to 50, you'll very quickly see a response. And if it goes to 50, honestly, you could see things happening like delaying completions to arbitrage, completing them later when prices are higher, and maybe even some choking and production curtailments too. $50 is not a good price for unconventional operators. Some of the wells will break even. The best parts of the Permian break even well below for $50 per barrel, but the companies don't. By the time you've added on the distributions and the overheads, you need $65 a barrel to maintain spend for the majority of lower 48 companies. I hope that makes sense.
Thanks, Fraser. No, and we hope that Diana got the answer in case she
That's
wants to go.
perfect. That's perfect. Yeah, I think is there the last question? There's one question.
I think we have a second question. Exactly, this one that Pierre kindly put on screen. Are you gonna
Your
read it,
analysis.
Fabiola,
This
first?
one we haven't asked this one yet.
No, this is a new one.
Yeah, so this one is coming from SPE France, actually. So your analysis doesn't mention or use the reserves for actions OC and NOC. Is this because reserves and reserve replacement ratio is not that important to you? It's a question from SPE France.
I mean, I guess the first point to make is obviously in a limited amount of time that we had, we decided to kind of take a look at production and how that's going to evolve in the coming years. But reserve replacement ratio, obviously super important to us. Something that we look at in a lot of detail, and it's interesting to see how it's evolved. We've gone from volume over value. We went to value over volume, which has largely stuck the course over the sort of last decade. During that period, we've been talking about stranded reserves. And companies have been looking at how do they get out of certain more carbon intensive volumes. We've been seeing some of the biggest reserve holders sanction mega projects to get these barrels and molecules out of the ground before they are potentially stranded in an accelerated transition scenario. But we're definitely seeing now, a shift back towards reserves again, reserve replacement ratios. Companies are talking about it more, setting targets around it. And it's all because of what I think Fraser had pointed out earlier. There is this risk that we are moving into more of a slower transition, a delayed scenario. And if that scenario does play out, if these companies want to stay at their current size, if they want to maintain their current share of overall production, then they are going to have to start thinking more about exploration again and thinking about reserve replacement ratios. So I don't think it's ever going to necessarily go back to where we were 10, 15, 20 years ago, but my sense is that companies are looking at this more than what they have done. But Fraser, feel free to...
Well, it's just so investors, Nivan, companies are actively getting questions about reserves replacement in a way that they have not for 5 years. Just for the record, our tools and services have always included reserves replacement metrics, and we keep a very close eye on this, and have been pointing out these issues for decades now for companies that have either over or understated their reserves positions, and also what countries, sectors, etc. would need to do and at what price to make things economic. So no, it's something that we think about a lot. I'm smiling because for the first time in 5 years, investors are now talking about that rather than talking about the things that they've been talking about for the last 5 years. But Nivan's absolutely right in that although they're talking about reserves replacement and they're all looking at how do they replenish resource hoppers and project hoppers and long-term cash flow, they are all still bound by capital discipline, shareholder returns, and the things that investors have gotten used to over the last 5 years. And that's why it's going to be so hard, as I mentioned right at the start, to ask these companies to go back and invest more and invest in growth. It's quite a change for a lot of companies to take that proposition to their boards and to their investors, and they're going to have to do it whilst having strong balance sheets and distributions. So we're very interested in it. It's a subject close to our hearts.
That's perfect. Perfect. Thank you.
Thank you, Fraser. Thank you, Nivan. And we're reaching now around 5 p.m. here in Paris, so we don't want to extend too much because we know you're quite busy and take much of your time. But well, first and foremost, we want to hugely thank you on behalf of SPE France. It's been a really insightful presentation, and it will be available on the YouTube channel for anyone to follow afterwards. And I think usually there are some follow-up questions and doubts, so maybe they can look for you both on LinkedIn or any way of contact you if they have right information. And I know that Wood Mac is always doing these very well done presentations that tend to come out every couple of weeks, sometimes months. So I guess it's something also you guys can let us know in the future, and we hope to have you again for a future webinar of this type. And of course, thanks so much to Fabiola, Carla, Vincent, and Pierre-Edouard, sorry, and everyone on SPE France helping us to organize the event. It seems easy, but it's always a lot of work and time behind it. And to let also everyone know that we're planning, as we mentioned in the beginning, several events for next semester. Hopefully as well with Nivan and Fraser, they're available again, and to have an update. Things are changing so fast that might be already quite some new material by then. And we're also planning some more on social charity networking events during the summer, yet to be confirmed. So we just do the last reminder of asking everyone to, of course, follow our latest updates on that we publish on both LinkedIn, as well as we send to our members by email. And that's why it's very important for our members, as Carla mentioned in the beginning, to keep their membership to date and renew their fees in case they haven't done it yet. So to be always getting the latest information and invites for these events, not only online, but in person, and all the benefits that SPE brings that Carla mentioned in the beginning. And I don't know if Carla, Fabiola, Vincent, of course, Fraser, and Nivan want to do some final comments or words.
Thanks very much for having us. Thank you.
So there'll be a short outro and then about SPE and the benefits of being a member. If you guys want to stick around after the end of our call, I'd like to have a discussion on some other aspects of the oil and gas that might be worth another webinar. Fantastic. Thank you.
Yeah, and also we'll remind everyone within the call, and also that we're going to share this video. Actually is live, so we're going to communicate through our social media. So thanks a lot for this incredible presentation.
Thank you.
Thank you all.
You know, people ask me why they should join SPE, and what I tell them is that SPE is absolutely essential. Frankly, if SPE didn't exist, somebody would have to go out and create it. When you graduate with a technical degree, a petroleum engineering degree, or other engineering degree, you get a lot of really good knowledge that gets you started on your career, and you learn a lot on the job. But the jobs that we have in this industry, they're really quite difficult. And you've got to have other resources either to solve specific problems you might be having at the moment, or to better understand how to solve, daily issues that you work on. SPE provides opportunities to learn about new things that people are working on. There are great articles in JPT magazine and the other magazines that we have that are really useful. If you're not reading JPT every month, I tell you it's essential to do that to keep up with the technology. We have excellent conferences where you can learn from people who have solved very difficult problems in our industry. And doing that is just incredibly important and incredibly useful. To me, I don't see how you can be an engineer working in the petroleum industry and not find value in the resources and the opportunities that SPE provides. It's an opportunity to meet people who can help you in the industry, and it's an opportunity to get the knowledge you need to be successful.